touch base with the Bank of Baroda. Mr. P.S. Jayakumar, MD and CEO of Bank of Baroda, joins in to talk more about the business outlook there on their earnings, especially. Mr. Jayakumar, it's great to have you on the show. Sir, thanks very much for taking out the time. One of the key highlights of Q2 was slippages at a 7-quarter low and core operating profit, including net interest income, improving. What has led to this better performance, and more importantly, will it sustain?
Well, we have to continue to work towards improving numbers, but a couple of things over here. One, most of the large ticket potential risks are all well known, and so I think, yes, we have to work hard. There are always risks, but I think we should try to sustain the general direction we have set, which is that quarter on quarter we should see a net reduction in the absolute amount of net NPA, a continuing growth in the book, resulting in lower ratios with respect to net NPA.
Right. Mr. Jayakumar, on the slippages front, can we expect lower slippages to be sustained? What is your outlook there, and recoveries and upgrades going forward?
So the outlook is this, that we think, what we are trying to do is to make sure that our net NPA number in absolute terms declines quarter on quarter. The balance sheet continues to grow, the asset book continues to grow, as a result of which the ratios show continued improvement. That is broadly the directions we set for ourselves, and we are working towards that. I think it's a number that would be possible as we end 31st of March 2019.
Right. Your margins have been sustained, Mr. Jayakumar. What's the outlook going forward? Would you be able to maintain or better your margins given the rising interest rate scenario?
So there are two aspects for us. One is the margin that we make on the international business and the margin that we make on the domestic business. For a variety of reasons, the international margins on the international business will continue to improve. We are seeing a rundown of low-yielding asset and replacement of them with high-yielding assets, a consequence of which the margins are improving. As far as the domestic sector is concerned, so long as we are able to continue to retain the growth on the current account and savings account, the cost of the overall cost of deposit will move in a very narrow range, and would be adequately, the margins would be adequately protected by the movement on the asset side as well. So overall, we are hopeful of sustaining the margins as they stand today. And as you notice in our financials also, in this quarter also, the increase in the cost of deposit is, I think, 1 or 2 basis points. And so, and so long as a mix of liabilities in terms of current account, savings account, and continues to be sustained, it is entirely likely that the margins will stay on course.
You know, the big question on the street is really, the exposure that you would have to IL&FS and its entities. You've provided for 240 crores for IL&FS. How much more by way of provisioning do you expect to do over the course of the in the second half of this year? And in the worst case scenario, what kind of hit can one expect?
I will put it to you this way. There are broadly, we categorize these exposures into 2 parts. One is the exposure we have to the parent companies or the various subsidiaries, and then we have got exposure at the SPV level. 85% of our exposures are to SPV, at the SPV level, and based on the data we have, there is very good reason to believe the CODs on these assets have been achieved. They are paying on time, and whatever data we have suggests that the impairment risk on them is very subdued. On the parent company exposure, where we have 15% exposure of the total limits, we have taken some provisions this quarter, and we need to continue to watch the position.
Now, there are concerns that the merged entity of Dena Bank especially may dampen consolidated profits of BOB when they will be consolidated. What do you have to say to your investors?
No, we've discussed earlier as well the synergies that are likely on this merger. This includes a better distribution for the combined banks, particularly in high GDP growth market. We've discussed about how product sets that we have and can be extended to customers of the other bank and vice versa. We have discussed about how employees of the organizations would have better opportunities in terms of locations, products, etc. We discussed about the fact that the international machinery, international presence we have would also be of strong support to the customers of the other banks. So there are mutual synergies that are there. There is a significant opportunity for a lockout market share in Gujarat, for example. So those are all there, and as with anything else, we have to work hard to ensure the synergies are actually realized.
So on the NBFC front, what is your assessment of the recent stress in the NBFC space?
As far as the second question is concerned, as far as Bank of Baroda is concerned, we have disclosed the extent of our exposures to NBFCs, which is in the order of about 72,000 crores. We continue to look at lending opportunities to them, subject to the quality of the asset and prudential lending norms. We remain in the asset purchase market. So overall, our presence continues to be there, and within the context of our overall limits, sectoral limits, caps, etc., we'll continue to be present in lending to NBFC and being in the asset purchase market. But I want to underscore the fact that in whatever we do, we have to ensure that we stay within prudential norms and focus on ensuring the lending is adequately structured to provide adequate protection for us as lenders. As far as that is concerned, that's a position. As far as the opportunity for growing retail assets is concerned, we have been on the track. Our balance sheet has been growing by about 35%, or our other asset book has been growing by about 35% in this quarter, and we have seen substantial similar numbers in the earlier quarter. So the plan that we have envisages growing our retail balance sheet through investment in distribution, better product, and increased focus on cross-selling to our existing customer base. It is not predicated on somebody exiting the market. The opportunities with respect to the NBFCs in the short term seems to be ability to do some certain level of coordination with them. Being able to purchase assets provided they fit into our criteria. So there would be short-term benefits that would accrue, but really the focus of a bank is to grow the retail business based on the strength of a distribution and on the strength of a relationship with existing customers.
Mr. Jayakumar, it's been an absolute pleasure interacting with you. Thanks very much for sharing more details about your earnings, and we wish you the very best for the future.